Hey guys, Ken Boyd with the Accounting Accidentally website, where you can find over 300 blog posts. If you scroll down to the bottom of the page, actually toward the middle, you'll find over 400 YouTube videos on accounting. And you can also join our accounting community conference room, where you'll see I'm going to start kicking off live chats on this site. So I wanted to talk about a subject that is tough. I'm going to go to full screen here, and that is lease accounting. The rules in recent years for lease accounting have changed. I've done a continuing ed presentation on this, and I've added some content that I've put here because I think it's so difficult. So, who are the parties in a lease agreement? Well, we have a lessee who is renting, if you will, from the lessor. The lessee has an expense in red, the lessee gets income in blue. And we have different types of leases, and this language has changed in the recent lease accounting updates. A financing lease, think of eventual ownership. Eventually, the lessee is going to own the asset. As opposed to an operating lease on the left, you're just going to use the asset and return it. So you can think of financing as eventual ownership, and operating is really just renting. On the lessor side, the language is different. You have a sales type or direct financing lease, think eventual sale, and an operating lease. Also, that language is used for lessor. You're leasing the asset as the lessor and getting it back. When we talk about lease components, we have to consider, well, what products and services do we need to use the assets? So if we have a piece of machinery, do we have all the component parts we need to run the machine? And that we will see in lease accounting that you can have lease and non-lease components, and the valuation of each of those components becomes difficult. But I wanted to mention that as an overall comment. Consideration is a business law term. Somebody needs to give something up in order to get something. And in a lease, we can have variable consideration. And if that's the case, the lessor who is leasing the asset recognizes income when it is earned. What does earn mean? That means that the variable portion must be determined before the revenue is earned. So if the lessor is leasing space and gets an additional payment if all the rooms in the space is used, they don't get that additional payment until they can show that, in fact, the lessee used all the rooms, for example. Another example, recognize revenue when a number of users reach a specific number. That's a good technology example. Right to use the underlying asset. Can the lessee benefit from using the asset now? Does the lessee have sufficient resources to use the asset? Is there anything missing? Similar to what I did on the prior slide. Is the right to use dependent on some other right in the contract? These are all variables that are considered, and right to use is important for determining when the actual lease starts. Transfer of control. If the lease effectively transfers control of the underlying asset, then it's a financing lease for the lessee, sales type lease for the lessor. There's no transfer of control for operating leases. Finally, let's talk about the definition of economic life. Just like with depreciation, economic life can be based on useful life, the period of time we use the asset, or based on the number of units produced. Let's say we're leasing a machine, we expect it to produce 100,000 units. If it produces 20,000 units in the first year, we use that 20,000 divided by 100,000 to determine the economic life. It's similar to depreciation methods. Leasehold improvements, think of as the cost of getting things back to where they were. So the lessee is obligated to return the underlying asset to its original condition. The cost associated with removing leasehold improvements that the lessee installed is part of leasehold improvements. So if the lessee put in landscaping that the lessor says in the contract must be removed, that's an additional cost. They are not considered lease payments. Instead, we use asset retirement accounting. And when we talk about variable lease payments, as I said on the prior slide, pay attention to the commencement date. Commencement date of the lease is very important. Is there a change in facts or circumstances that occurs after the commencement date? And finally, an unusual term, the substance fixed payments. If a payment is written as variable, but really the payment's unavoidable, then it's considered a fixed payment. which is the principle of conservatism going on with lease accounting. So that's what I wanted to cover on leases, and I did want to remind you that Conference Room is my accounting and personal finance community. You can explore it, see all the posts that are in here, and you'll also see chat starting pretty soon. So thanks for watching, and we'll see you next time.